let's talk about the Treasury bond safety for a second. And because that underpins the entire global financial system, but we've been watching the liquidity in that area drop and drop and drop till we had that one mismatch in 2015 was the first one that really reared its ugly head. And according to the TYVIX, which is no longer published, but so that's the Treasury Volatility Index. When you look at it, you can see where the traders took over that arena. So can you talk a little bit to the liquidity and the implications for that underpinning the global system?
Yeah, you spoke about 2015 and then in 2020 as well, there was a lot
Mm-hmm.
of volatility and problems
Mm-hmm.
in the treasury market. And I saw one of the Fed presidents recently said that the treasury market is shaky and again mentioned the liquidity problem. And it's been mentioned for the last few years. And basically, I remember I started out, when I started out, I did treasury cash trading, and the bid and offers were very tight. And there's a lot of like let's say you could buy a 2 year for par, and 2 30 seconds was the bid, and 2 1/8 of a 30 second was the offer, and there's 50 million on each side. So very liquid, but nowadays the bid and offer spread is widening and there's less liquidity. And and I think the major reason why this is happening is because the the debt's grown so much and the central banks are a big part of the owners. So there's no real organic demand for treasuries anymore, because who'd want to own something that there's so much of it out there? And I think that that's a big problem as well, the liquidity. And when you see like what's happened in the last 2 days, the volatility, where yields yesterday dropped like
So,
40 to 20 basis points, and today they've gone up
right.
again. Uh, yeah, the market makers in the banks and brokers, they're gonna make a much wider bid and offer. It's like in gold, the bullion dealers. If the market is volatile, they're gonna take a bigger premium because they're gonna try to hedge their exposure, and it's the same thing for treasuries. And it's supposed to be what underpins, like you said, the whole world's financial system.
So how safe does that make you feel?
Not too safe.
That's why you own this.
Yeah, that's right.
This. Because it's
It
not
all, it
safe.
all roads lead to gold and silver, I guess.
Is you know what? Doesn't it look like that? Because this is not the time to speculate, right? And the Fed does not have yours or my back. And okay, this the statement, and then we're kind of running out of time. But the statement that we're going to backstop everybody, we're going to pay all these uninsured deposits, but that's not taxpayer money because it's supposedly coming out of the DIF fund, which, as you said earlier, it's actually like 128 billion dollars to underpin that, what, 17, 18 trillion in there. I mean, how is it that it's not, that the taxpayer is not the one that's going to end up paying for this puppy?
Yeah, aside from the FDIC 125 billion, the Fed is just gonna load up its balance sheet, take all those losses, and that makes the currency worth less. So it's a hidden tax of inflation.
It's a hidden tax of inflation, and ultimately, taxpayers, and they do say this, are responsible for the Fed's balance sheet, as we are for the government balance sheet. So, personally, I think it's garbage when they say that the taxpayer isn't going to pay for this. So, don't call it a bailout, just like don't call it QE, because it's a little different. Yeah, it's not really any different.
It's a
Well,
backstop, according to them.
yeah, well, who's got their backstop?
We
Who's
do.
backing stop exactly? If you like this clip and you want to watch the full video, just click right here. And to subscribe, click right here.